Tyler closed $218,000 last year in roofing sales. I've watched this exact situation play out more times than I can count. The rep who has his best year ever and genuinely believes this is the year everything changes financially. Tyler's wife thought the same thing. They were finally making real money. Then January hit. The pipeline went quiet. She opened the bank app and showed him the balance without saying a word. If you're sitting there thinking, I make good money, but I have no idea where it actually goes, you're not alone. That feeling isn't weakness. It's what happens when nobody builds a system around commission income. Here's what nobody's telling you. $218,000 gross doesn't land at $218,000. By the time taxes that weren't set aside, a truck payment, slow months floated on a credit card, and a big October spent like it would never end are done with the money, that number looks completely different. The income was real. The math just didn't work out in his favor. This video traces exactly where Tyler's $218,000 went, which decisions quietly wrecked his net worth, and what a real cash flow system looks like for someone on commission income who's done feeling broke on a six-figure year. Let's get into it. Let's start with the number that actually matters. Not $218,000, the number that actually showed up. Tyler's 1099. No employee withholding, no payroll department setting aside taxes. So right off the top, federal self-employment tax plus income tax takes a real bite. For a 1099 rep in his bracket, a combined federal tax burden somewhere between 28 and 35% is realistic depending on deductions. Call it 30% and be conservative. That's $65,400 gone before Tyler buys a single thing. Except Tyler didn't set that aside. He spent the checks as they came in, so now he doesn't just not have the money, he owes it. That leaves roughly $152,000 in pre-tax spending power. But here's where it gets painful. Tyler's income didn't arrive in 12 equal deposits. It came in waves. March was slow, April was okay, May through July were strong. August and September were his best months. October was decent, then November and December slowed down. January was the month his wife showed him the app. That's not 12 months of income. That's 4 or 5 months doing the heavy lifting and 7 months living off momentum. When income is lumpy like that, most people default to one behavior. They spend to the level of the good months and borrow through the bad ones. Tyler didn't think of it as borrowing. He thought of it as floating. But floating on a credit card at 24% interest isn't floating. It's sinking slowly. Now here's the number you need to hear. If your commission deposits feel like income and you're treating each one as fully available to spend, you're running Tyler's math. Part of every check belongs to the IRS. Part of it belongs to February. The system has to account for both before anything else moves. Now, let's go line by line. This is where most guys stop reading because seeing it written out is uncomfortable, so stay with it. The truck. Tyler's truck payment is $850 a month. Insurance runs $1,100 a month because he added the boat on the same policy and has one incident from 2021. That's $1,950 a month in vehicle costs before a single gallon of fuel. Over a year, that's $23,400. Not a business asset, a fixed obligation that doesn't care what month it is. The house. Tyler bought when rates were still manageable, but bought at the top of what the bank approved, not the top of what made sense on variable income. Mortgage, property taxes, and insurance together run $2,800 a month. That's $33,600 a year. Fine when commissions are flowing, terrifying when they're not. The credit cards. Tyler has $11,000 across 2 cards. He's been carrying that balance for about 18 months. At an average APR of 22%, he's paying roughly $200 a month in interest alone. He's not paying it down, he's treading water. And every slow month, the balance creeps up a little bit more. The tax debt. He didn't set aside enough last year either. He owes the IRS $14,000 from his previous filing and is on a payment plan. That's another $500 a month going backwards, not forwards. Lifestyle inflation. This was harder to quantify because it doesn't show up as one line item. It shows up as the boat he bought in July when he had 3 strong months in a row. The family vacation in August because he felt like he deserved it. The new watch, the season tickets, the dinners out when a deal closed. None of it felt like a mistake in the moment. It felt like success. That's the trap. Tyler spent roughly $28,000 on discretionary items in a year when he had no tax account, $11,000 in credit card debt, and a mortgage that required a strong commission month just to feel comfortable. The gap month float. Between November and February, Tyler's commissions dropped sharply. He covered the gap with $9,200 in credit card charges. That's not a spending problem, that's a forecasting problem. He didn't know the drought was coming because he'd never mapped his own income cycle. He'd been in this long enough to have lived through this pattern before, but he'd never written it down. Add it up. Taxes owed but not saved. truck, mortgage, credit card interest and minimum payments, IRS payment plan, discretionary spending, gap month float. Tyler didn't blow his money on one catastrophic decision. He bled out through 100 small ones and one structural failure. No system between the deposit and the drought. Now, before we get into what Tyler's system should have looked like, hit subscribe if you haven't done so already. I break down the money side of commission income every single week, specifically for people in this business who are tired of making good money and having nothing to show for it. Now, let's get into what actually fixes this. The breaking point isn't dramatic. It doesn't come with a foreclosure notice or a repo truck in the driveway, or at least not the first time. It comes as a conversation, usually late at night, usually after his wife has checked the bank app one more time and they've both been quiet for a few minutes. She's not angry, and that's the part that gets you. She's tired. She's been watching the account bounce between flush and empty for years, and she can't figure out the pattern either. She believed in the income. She still does. But she's starting to wonder if the income is the problem and not the solution. The first response a lot of guys have is to grind harder, book more appointments, work the weekend, chase the next storm. The income will fix it, except it won't, because the system is still broken. More money into a system with no structure just means more money cycling out faster. The second response is to stop and look at the machine. That's the one that actually changes things. Here's where the income story changes. And I want to be specific because vague financial advice is useless to someone in commission sales. The first move is a tax account. Before Tyler spends $1 of any commission check, 25 to 30% goes into a separate high yield savings account labeled IRS, not savings, not emergency, IRS. That label makes the money feel already spent, because it is. This one habit alone would have kept Tyler out of the payment plan and put $54,000 to $65,000 sitting in an account, earning interest while he waited to file. The second move is income mapping. Tyler needs to pull his last 2 years of commission deposits and map them month by month. He'll see the pattern immediately. Big months cluster, slow months cluster. Once he sees it, he can build a monthly floor number, the minimum he can realistically count on in a bad month, and run his fixed expenses against that number only. The truck, the mortgage, the insurance, the minimums, all fixed expenses have to survive on the floor income. Anything above the floor gets allocated in order. Tax account first, debt pay down second, reserve third, investing fourth, discretionary last. The third move is a real reserve. 3 months of fixed expenses in cash, sitting in a separate account, not touched for anything that isn't a genuine emergency. For Tyler, that's roughly $18,000 to $20,000. That fund is what keeps him off the credit cards during a slow stretch. The fourth move is attacking the debt in order. The IRS payment plan first, because that debt accrues penalties on top of interest. The credit card second, highest rate first. Tyler can be out of both within 18 to 24 months if he runs the system correctly and doesn't add new debt during slow months. The boat goes. The season tickets don't renew. Those aren't permanent sacrifices. They're the cost of building the foundation so the next big year actually sticks. The fifth move is automating the investing before he can talk himself out of it. Once the debt is gone and the reserve is funded, a fixed amount moves into a retirement account on the first of every month. Automatically. Not when it feels right, not after the next big commission. Every month. The amount doesn't have to be large to start. That habit just has to be consistent. Here's what I want you to hear. Tyler isn't a bad husband. He's not irresponsible. He worked hard all year and closed real deals. He just had no structure between the money coming in and the money going out. The income was there, the system wasn't. And you can have both. You don't need a perfect month to start this. You don't need your best season to build it. What you need is a repeatable structure that works even in February when the pipeline is quiet and the bank app is the scariest thing in the house. The 102% cycle isn't your destiny. It's just the default. And defaults can be changed. Hey, Roof Money Pros, if this hit close to home, hit subscribe. I put out videos every single week specifically for people in commission income who are done making good money and having nothing to show for it. And if you want the exact framework, the Feast Your Famine Survival Guide is at the starting point. It walks through the first step of the feast system that separates Tyler's story from a completely different outcome. Links in the description. Thanks for watching, and in the meantime, keep stacking, keep building, and I'll see you in the next one.